Like absolutely everyone else, I came into trading just for the sake of money. But after 5 years, I've realized that really the habit of a successful trader, the mindset of a successful trader, the entrepreneurial skill of a successful trader is completely different to what I imagined when I started out. Unfortunately, it does bother me when I see a lot of advice on social media about how a trader should act. And it's a lot of kids coming on social media glorifying basically gambling. And they'll come in, they'll treat it like a side hobby, they'll full port accounts, they'll maybe look like they're doing something. Most people are not even profitable. Look at the amount of people that actually make it in the prop firm world and in the trading world in general. It's very, very small. It's an industry that has been designed like that because losers pay winners. This is really the skill of trading. Every single time you lose a trade, you're paying a winner. Every time you win a trade, you're taking from the losers. This is the market. This is the game that you're playing. So you're telling me that you can come in half bothered and actually make an income from this? You are in a dream world. You're in fairyland. So you need to think like a successful trader. You need to adopt these habits. After 5 years, I've realized what it actually is. I pulled out over 6 figures from the market in verified results from multiple different prop firms, and I am actually managing my own capital as of now alongside that. That's something that I've only recently ventured into. I had done it in the past. I stopped doing it just to focus on this opportunity of prop firms because it is the biggest opportunity out there right now, and I still advise anyone that's getting into trading to go the prop firm route because you're going to make way more money. And even if you are someone interested in trading and you're doing well, you should still be doing prop firms because you can make a big sum of capital. Even if you are trading your own personal accounts, I don't see the harm in trading funded accounts on the side because you will make probably 10, 20x what you're doing on your personal accounts without a lot of risk on your own. With that being said, what I learned during this whole time is that I need to think like a risk manager. And the thing is, a lot of people that come into trading don't think like this. They just think about the money. They just think about maybe that one individual trade. But you should not see yourself as a funded trader. This is what the kids see themselves as. You should not see yourself as, okay, I'm just trying to make $2,000 a month. Think a lot bigger than that. You're not just a trader. You're not someone that just looks at a chart and clicks a button. You are the fund manager. You are the person in control of all of the allocation that you have been given. What would you do if that was your mom's mortgage on the line? Would you be treating it like you do with these prop firm accounts? Would you be treating it like that? Actually, I want to put on one of my track records on the screen where I've made $44,000 of profit with Alpha Capital Group from one funded account. The reason why I say this is because a lot of people, they treat this prop firm game like, okay, let me get an account, let me full port it, make a huge payout. They're going to blow another 10 accounts after that, go maybe break even from what they've actually made, and then try and do it again. And most prop firms are going to ban you after time because, you know, you're full porting your live account. So you're already a risk to the firm. And you will not be sustainable in the long run. I want people to actually see this as something that they can do forever, something that they can do long term. So think of yourself as the fund manager. What would a fund manager do? It's no different to owning actual real funds. You have $1 million, you have $50,000 of your funded account, $100,000, $300,000. Right now, I'm managing way over $1 million, pretty close to $2 million in funded capital. And what this has allowed me to think of as I've got to this stage is that I am in control of that whole allocation for every single trade. So I might put a different bit of risk on every single trade. So people think that I'm very static, but I'm not. And think like a hedge fund. So the way that hedge funds are and the way that their risk management allocation works is that they might have low risk assets, they might have high risk assets, and they might have medium risk assets. So with the low risk assets, they might put a big chunk of that actual portfolio. Let's say they've got 500 mil. They might put like 300 million into very, very safe funds like the S&P. Things that always go up, good, very high impact stocks, very low impact stocks. They might have a medium risk allocation where they put like a lot of money into gold, etc. And the high risk, which is what you and I are doing on a daily basis, is the actual mechanical and discretionary trading where someone is literally in control of funds and putting risk on the line every single day. This is completely different to investing. So see it as that. So now when you have about 2 million in funded capital, think of it as the same. You've got 2 million, but do you need to put all 2 million on the line on every single trade? Of course you don't, and you shouldn't. So you might say, this trade, very good setup. I know as a trader that's been in the market for 5 years, and you should know, this is how you need to think. Every single trade has the exact same chance of losing. Even if it's a great setup, there is absolutely no guarantee that a setup is going to win. So you do not try to go all in on any setup that you ever do. You have to accept that this is very high chance that this is going to be a loss. So with 2 million in capital, let's say, I might say I decide to put 500k on the line on this setup. I've still got 1.5 million left over on the side that I can allocate with different trades. So let's say on this one, I take a loss, and this is all funded capital. So I can go to my next 500k, and I've got 4 groups of 500k, and I'll put 500k on the next trade. This is because a very good seasoned trader does not think in wins, they think in losses. A bad trader, a decent trader, someone that's, made some money, they only think in wins. They think in, how much am I going to make if this trade goes right? You need to always think, how much am I going to lose if this trade goes wrong? It's very good and well to think about the wins. And I'm going to make $15,000 if I close this trade at my exact target, but we're not living in a dream world. So think of yourself as the risk manager. You have a job. This is a whole job at hedge funds, the risk manager. You are the risk manager. Okay, what is the scenario that this trade is going to lose? How much funds should I allocate? How much of my portfolio should go on this one trade? How much am I going to lose? How much am I going to win? And there's other good scenarios that I could talk about this and that I've seen people make many mistakes with. When I've seen some of my students do it, and I've had to actually give them in trouble for this, but it's like, you are aiming for, let's say, 2.1% for this trade. This trade, your target, 2.1%. So let's say you've got a 200k account. You're aiming for around $4,000. Let's say 2%. You're aiming for $4,000. You are up 1.9%. So you're aiming for 2%. 1.9%, you are already up. High impact news comes out in 1 minute, 2 minutes, 5 minutes. Do you risk losing the full 1.9% by not closing at the high impact driver for the small chance to make 0.1% and fully finish off the trade? Now that is absolutely just, it's very, very silly. Now the inexperienced trader thinks, well, I've been taught that I should only close my trade when it hits my full profit target because that's what a good trader should be doing. And that is completely incorrect. A good trader manages the risk, The risk is, I have 1.9% on the line. There's a high impact news driver in 5 minutes. Do I risk 1.9% of profits that are already gained to make 0.1%, which is where my target is, just to give me the dopamine boost to say I hit my target? Now, in other scenarios where it's a very smooth sailing trade, you've already hit a very good target, there's no high impact news that could drastically change the position of your trade. Or maybe let's say you're only running 0.4, 0.5%, you're aiming for 2%, and then high impact news is coming out. You look at the risk to reward, the scenario. Okay, well, I've got a 30 pip SL. Look at the average amount of pips that news actually moves. Say this news, it's a high impact driver. I'm already 30 pips in profit. I've also got a 30 pip stop loss. So from here to my stop loss, there's 60 pips of room. If the news driver moves 30 pips, I'm still at break even. The risk of me staying in the trade is less significant because I'm not so close to my target. So if I do let this news event run, I might, actually go either into break even, or maybe I go a lot deeper into profit on my trade. So the actual risk in this scenario is very different because you're not risking a substantial amount of profits. You've already looked at what high impact driver there is. Where is my stop loss? Is it safe for me to be in this position? Is it worse for me or better for me? What is the ideal scenario? So what I've learned in these 5 years is you are taught to look at every trade the same. And whilst every trade should look the same and every trade should fit your exact same criteria, every trade should slightly be looked at a little bit differently. And the reason for that is because you are the risk manager and you need to make decisions that is good for the fund. Think about yourself as that kind of guy. You're managing the fund. What's good for the fund? Not what's good for you, what's good for the fund. If I make a decision where I am putting the fund's allocation on the line, think about all the people that are impacted by that. If you are the fund manager and there's people working under you, there's clients' money that you're investing. And I want you to think about your capital exactly the same, because you will never get to the end stage where you actually are dealing with clients, investors, if you aren't the person that has the morale to deal with that right now. So think like a hedge fund. Think about low risk, high risk, medium risk scenarios. For me, I have two models, an intraday model and a swing model. You are taught to risk the same in every scenario. I don't risk the same on every scenario because my swing model, mathematically and logically, has a lot less risk on the line because of the mathematics of it. My swing model, generally takes a lot longer to actually find a trade because there are less candles on a higher time frame chart than there are on the 15-minute chart. So naturally, if I get one decent swing opportunity a week, or even less, one every 2 weeks, I have the ability to potentially risk a little bit higher in this position. Let's say I go 1.5, 2% risk on the swing. But on the intraday, I'll never go more than 1% risk because the intraday mathematically has more chances for an actual entry. The frequency is higher, so I might be able to get 2 positions per week. Whereas with the swing, there's very, very low circumstances that I would actually be able to get 2 swing opportunities per week. So you look at these things. Because I have 2 models, I can think about that. My swing model, I can risk a little bit more because I'm the fund manager. I understand the math and logic behind the trade frequency. With the intraday model, yeah, you're taught to look the same, think the same. They're all the same. It's not all the same because mathematically, the intraday model appears more. So I do need to lower my risk on this specific setup. And that is exactly what a hedge fund would do. When you have a higher chance of risk on absolutely anything, your risk should be lower. When you have a lower chance of risk for something, your risk could potentially be a little bit higher. That's why if a bank is taking a position that's going to be on the monthly chart spread across 7-8 months of the year, they have a chance to put a little bit higher risk than you do on your 1-minute chart, because your 1-minute trade will appear 5 times a week. That position will appear maybe once, twice a year. So they have put obviously a lot larger because they have allocation for a lot larger funds anyway. But they have the ability to do that. And not only that, because the stop loss size is way higher, they have less risk in general because they have many chances that they can cut the trade early. Something's gone wrong. There are fundamental reasons to close this trade. And exactly the same the other way. Prices moved 700 pips from when they entered in March, and it's now September. They had the chance to move all of their positions to break even and scale in multiple times. These are the things that a trader should think about, that every single style is a little bit different, and you need to think like a hedge fund in order to get results like the trader that you actually want to be in the long run. And if you are the trader that wants to get investors and wants to get a hedge fund and eventually wants the funds for people to actually take an opportunity, and this is your career and you want to do this forever, you can't be the guy that's full porting live accounts on funded brokers and expecting that I'm going to build a track record and I'm going to do this forever. You need to start thinking like this now. So that is my advice. Think like a hedge fund. You are the risk manager. You are the manager, the CEO of that fund that you're trading right now. Doesn't matter if it's $25,000. Doesn't matter if it's $1 million. You need to be that guy now, because if you do it now, you will take the skill on for life. Always learn to think in probabilities, think in risk, think in pros and cons. That is how a trader works. You don't think about any emotions ever. Detach yourself from that. And when you do think in emotions, you need to think about probable causes and things that might trigger you in the future. So for example, if I know Friday is a low probability day for me, I might decide this scenario, all trades look the same. That's what we say. All trades look the same. This looks like a very good setup. I do want to take it. But I, as a fund manager, might say, if I lose a trade on this day, because I know I don't like trading on Fridays, my data is low, but it is a very good trade. It's exactly like all my other trades. I might take it, but I might, as the fund manager, make a decision that I want to take this with $300,000 in capital instead of $500,000 in capital. Because the trigger that I might cause if I was to lose on $500,000 of capital is not worth the reward if I'm actually to take a loss on this, or it's not worth the risk for me to have a trigger, because if I take a trigger and I'm not happy with the decision that I've made, then it might trigger a response next week that I start gambling my account. So a trader thinks in all of these different things. You need to see 5 steps ahead. How is this going to affect me mentally? What is the decision that I'm doing here? What's the risk for this specific trade? What's my account health? If you're in 7% drawdown, you definitely are, and you don't think about it now, you are going to be trading subconsciously very differently to when you're in 7% of profit, because these are completely 2 different scenarios. So always look at these things, manage trades, look at, and if it helps, make a spreadsheet every single time that you're going to enter a trade. Just write it out. Pros of this trade, cons of this trade, risk that I'm willing to actually lose on this trade, reward that I'm willing to gain, what are the potential risks of this trade, what high impact drivers are coming out, and you can think about this throughout the trade, and then you make your decisions from there.